FX derivatives, or foreign exchange derivatives, are financial instruments that derive their value from the exchange rate of two currencies. They are used by businesses, investors, and institutions to hedge against currency risks, speculate on exchange rate movements, or facilitate international trade. The most common types of FX derivatives include forward contracts, futures, options, and swaps. A forward contract is a private agreement between two parties to exchange a specific amount of one currency for another at a predetermined rate on a future date. For example, an importer in the US expecting to pay €1 million to a European supplier in 6 months might lock in today's exchange rate using a forward contract. This ensures the cost remains fixed, regardless of fluctuations in the euro to dollar rate. FX futures are similar to forwards, but are standardized and traded on exchanges. They require daily settlement through a clearinghouse, providing more transparency and reducing counterparty risk. For instance, a trader speculating on the strengthening of the British pound against the US dollar might buy pound sterling to US dollar futures, aiming to profit if the pound's value rises. FX options give the holder the right, but not the obligation, to exchange currencies at a specified rate before or on a set expiration date. There are two types of FX options: call options, the right to buy a currency, and put options, the right to sell a currency. For example, a US-based company expecting to receive payment in Japanese yen might buy a yen put option to protect against the yen weakening, while still allowing them to benefit if the yen strengthens. FX swaps are agreements to exchange a set amount of one currency for another for a specific period, with an agreement to reverse the transaction later. These are commonly used by multinational corporations and banks to manage short-term currency needs. For instance, a company with cash in euros but expenses in dollars might enter into an FX swap to temporarily exchange euros for dollars and later revert to euros. The primary purpose of FX derivatives is risk management, particularly for businesses involved in international trade. Currency exchange rates can be volatile due to factors like interest rate changes, geopolitical events, or economic data releases. For example, an exporter from Japan selling goods in US dollars might use FX derivatives to ensure the yen value of their revenue remains stable, protecting profit margins. While FX derivatives offer significant benefits like hedging and speculation opportunities, they also carry risks. One major risk is market risk, where unfavorable currency movements result in losses. Additionally, counterparty risk exists in OTC contracts, as one party might fail to meet its obligations. However, exchange-traded FX derivatives reduce this risk by using clearinghouses. FX derivatives are widely used by corporations, investors, and financial institutions to navigate the complexities of global currency markets. By offering tools to hedge risks, lock in exchange rates, or speculate on market movements, they play a vital role in international finance.